So the Federal Reserve just laid out its game plan. But here's the catch. It only gets us through 2025. After that, the map just ends. We're going to walk down this short, clear path together. And then we're going to peer into the thick fog that lies just beyond it. Because trust me, that's where things get really interesting.
And you know, this quote from Barron's just nails it, doesn't it? The path is clear. After that, less so. It's like a tale of two forecasts, right? First, everything's crystal clear, and then it's a total whiteout. So what is this clear path, and what's causing all that murkiness down the road?
All right, so here's the big headline. The Fed just trimmed its benchmark rate by 1/4 point. That brings us to this new target range you see here. Now, this wasn't a huge surprise. Wall Street was pretty much expecting it. But this one little move, it sets the stage for everything we're about to talk about.
Okay, here's our game plan. We'll kick things off with what they're calling the insurance cut. That's the clear part of the story. Then we'll take a little trip back in time to see the ghosts the Fed is dealing with. After that, we're diving into the dot plot, and you'll see why that's so important. Then the big political question mark for 2026. And finally, the most important part. What does all this mean for your money?
All right, let's start with the easy part. The clear path. The Fed has basically handed us a roadmap that's good for about the next year and a half. And it all boils down to one central idea. This recent rate cut, it wasn't a panic button. Think of it more like an insurance policy.
Yeah, that's exactly how Fed Chair Jerome Powell put it. He said this isn't about reacting to some crisis happening right now. It's an insurance policy. See, the big risk they're worried about down the line is a potential slowdown in job growth. So even though the economy looks okay today, they're making a move now to try and protect it. It's all about managing risk.
And this timeline lays it all out perfectly. You've got the cut that just happened, and then the Fed has basically signaled they're planning 2 more of these little 1/4 point cuts before 2025 is over. This right here, this is the certainty we've been talking about. But man, you can see it right there. It's a really short road.
Okay, now here's where it gets really interesting. The Fed isn't just making this stuff up as they go. They're haunted by history. They're basically trying to walk this tightrope between 2 massive and very different economic disasters from the past. And this is where that clear path starts to get a little complicated.
So on one side, you've got the ghost of the dot-com bubble. Remember that? Back in the late 90s, Fed Chair Alan Greenspan did something similar, an insurance cut. But what happened? It just poured gasoline on an already raging fire and helped inflate that massive bubble. Then, on the other side, you've got the 1970s. The Fed eased up on rates in the late 60s and, well, that helped kick off the crazy, runaway inflation that defined the next decade. So you see the dilemma? 2 totally different kinds of catastrophes, and Powell's Fed is trying to steer the ship right between them.
And this is the moment, right here, where that clear road just dissolves into a thick fog. And you want to know the craziest part? The best proof of all this uncertainty? It comes from inside the Fed itself. It's all laid bare in this really fascinating thing called the dot plot.
So what is this dot plot? It's basically a peek behind the curtain. It shows us what every single voting member of the Fed thinks interest rates are going to do. Each dot is one person's anonymous prediction. It's supposed to give us clarity, right? Well, this time around, it did the exact opposite. It showed that they are absolutely all over the map.
Okay, get ready for this because this is wild. The official story, the median forecast, says 2 more cuts. But look at the actual dots. Out of 17 people, only 9 actually agree with that. You've got 6 members who are saying, nope, we should stop cutting right now. And then you get the real outliers. One person thinks they should hike rates, and another wants to slash them by a full percentage point. It's just a massive disagreement.
And that is why looking at that one median number is so misleading. It's like taking the average of a bunch of completely different opinions and calling it a plan. It completely hides this massive argument that's happening inside the Fed. Even Powell himself basically said, yeah, we don't have a lot of confidence in these predictions right now.
So, if a Fed that can't agree with itself isn't enough uncertainty for you, don't worry, there's more. An even bigger wildcard is looming just past that 2025 horizon, politics. We're talking about a potential shakeup of who is even running the Federal Reserve. Think about this. For starters, we're getting a new Fed chair. That's a big deal on its own. Then, depending on how some political and legal things play out, you could see Trump appointees holding a majority on the Fed's main board. And wait, there's more. The contracts for all 12 of the district bank presidents are up for renewal. That used to be a rubber stamp, just a formality. Not anymore. The whole thing could completely change the Fed's playbook.
Okay, so we've got this short, clear path,
and then this huge fog of uncertainty. It's a lot of high-level stuff, I know. But what does it actually mean for you, for your bank account? Let's bring this all down to earth and talk about your money.
Well, a rate cut is always a double-edged sword, right? If you're a saver, the good times might be winding down. You know those juicy high yields you've been getting on your savings accounts? Yeah, those are probably going to start getting smaller. But if you're a borrower, it's a different story. Things like credit card rates or home equity lines of credit, those are likely to come down. But here's the one big catch: mortgages. Don't assume they'll drop just because the Fed cut rates. They play by their own rules.
So, if you're an investor, what's the move? Well, the thinking seems to be shifting. This isn't necessarily about chasing the hottest tech stocks anymore. It's more about finding solid value in stuff that can weather a storm. We're talking about defensive areas like healthcare, or maybe smaller companies that really benefit when it's cheaper to borrow money. You can see a bunch of specific ideas here, but the big picture, the main takeaway, is a shift toward things that provide yield, diversification, and just plain old stability.
In this quote, this one from BCA Research just hits the nail on the head. It says, what used to be the anchor of portfolios has instead become a roller coaster. Think about that. Government bonds, the thing that was supposed to be the safest, most boring part of your portfolio, is now all over the place. The old playbook is kind of out the window, and that means investors just have to be a lot smarter and more strategic now.
So there you have it. The Fed gave us a roadmap, but it's a short one. After 2025, that road disappears into a thick fog of arguments within the Fed and huge political question marks. So the real question, the one you have to ask yourself is, the Fed has its plan for the next year. Is your portfolio ready for whatever comes after that?